Hey guys, welcome to an Architecture Real Talk. So today's topic is going to be a little bit interesting. I'm trying to sum up a lot of questions in one. These are all financial questions. How do I buy a house? How do I go about doing a mortgage? How do I build a custom home? If I'm an architect, how do I design a home and how can I own a home in this climate that we're in, right? Where everything is going up. Is it even feasible for me to do a custom home? So we're going to talk about all these financial questions. The first thing I want to say is I am not a financial advisor. Each one of your situations will vary, and based on your own circumstances, you can take some of this advice or you can take the latter. I'm going to be speaking from my personal experience, my investors, and my clients that have come to me when I provide a service as an architect. Now, one of the things you have to understand is when you purchase a home, you're either going to purchase it through cash value or you're going to purchase it through loan. If you got the cash, skip this video, go out there and buy yourself a house. Now, but if you are going to be buying the house on a loan, there's two ways to go about it. First way to do it is a pre-approval. A pre-approval is you go into the bank, take 2 years of your taxes, they're gonna pull your credit score, and just about that, and it probably asks for maybe 2 months worth of pay stubs. No more than that. They're not going to look at your debt. They're not going to do a deep dive into your bank accounts. They're simply going to give you a number. The number is going to look like this. It's going to be like, hey, we're willing to finance $210,000 of whatever property you decide to purchase. And you're going to take that paper and use that to place bids on houses. So most of the time, the houses do not sell for listing price. Depending on the market, you can either bargain them down or you can go in with a higher price. So a list price is just a starting price, more or less. So if the market is swinging towards a buyer, you'll end up going a little bit lower than the listing price. If it's going towards the seller, which is majority of the time, then you're going to go a little bit higher than the listing price. Let's say you secure the bid. You secure and you're the highest buyer, or you're the highest bidder, you now have the contract. The house goes on pending, you get an inspection done. The inspection is by means which you can negotiate if there's any flaws in the house. Move to appraisal. Appraisal is looked at by your bank and the bank says, hey, we're willing to back this loan, the property is worth it, go for it. And then you move towards closing within 90 days of that bid. You already secured the house. When you come to closing, you exchange keys, exchange property deeds, and the house is yours. That's the layman's term of it. That's called a pre-approval. A conditional approval is where you get all your finances, everything done up front. You go to the bank and you say, I need a conditional approval. You provide all your data, all your debt, everything that you have. They'll do a hard pull of your credit score and they'll say, your loan is already approved. We don't need a loan officer or anything like that. It's already pre-approved for this amount, provided if the appraisal value for the property that's going to come will be able to meet it. You'll still get a number, but a conditional offer or a conditional approval weighs more in the eyes of a seller than a pre-approval because you already done the majority of the work. You can close on the house 30 days after the bid. So that is a conditional approval. Obviously, that has more time up front, but the payout is better because you can probably go and purchase a house faster. So those are the two ways. Now, when it comes to custom homes, this is something like you have bought land. So you have to first buy the land. Location, 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 as they say in realtor terms, right? Once you have secured land, that becomes your collateral. You pretty much end up using that property as a means by which you will be able to acquire loans from that point on. And once you have this collateral, you either can do a one-time construction loan or a two-step construction loan. One-time construction loans typically have draw schedules. Draw schedules are pretty much milestones by which you're going to be acquiring debt. So imagine draw schedule as a credit card that you will be using to pay for every milestone of construction along the way. So let's For example, if you break grounds on the property, you're probably going to need a survey. You probably need to clear the site. You probably need to do some dirt work, go in with plumbing, go in with electrical. You probably need some level of power, and after that, you're probably looking at foundation. So all of those various milestones, you're going to be drawing money from that construction loan. We're going to be taking X amount of money out, and we're not going to be paying the amount that is due on that card until it will convert itself into a mortgage. But the amount we will pay on a monthly basis is going to be a 3%, 4%, whatever the interest that you have locked into that will convert to in a mortgage. That's what you're going to be paying. So it might be at first at $50, $60. And you will not be penalized unless you have completed construction within 6 months, 8 months, 10 months, or 12 months, depending on your loan. So as you're acquiring that debt is going to be collectively looked at and be converted into a mortgage. So if you were to look at a construction loan, it is set up in a way that is using your land as collateral, is probably going to hold a 10% retainage by the architect for pretty much until the certificate of occupancy as something that might come up or as collateral. So on a $200,000 loan, you're going to report to your contractor that you only have $180,000 to work with, so you don't break that loan. If you were hypothetically to go over your construction budget, you will need another loan, because a one-time loan, that is the drawback. You are pretty much guaranteeing a loan for that property or that house, and they're saying build it in this budget, $250,000, $300,000, whatever it might be, right? Again, your land is something that's taken into consideration to give you that loan as an amount. So the first thing would be to require or acquire land on cash value. So once you have gone through that step, your house will automatically go into a mortgage. Another advantage of having a one-time closing loan is you're only closing on it one time. So if you pretty much locked in a rate very, very early on, and it was a low rate and the rates have gone up, then the advantage is you're going to stay in that rate as you move forward into your mortgage. So that's pretty much how a construction loan works. Another type of a construction loan is a two-time closing loan. Thereby, you have the flexibility in that market. So you can have a construction loan be taken from one company, and it might give you a great rate, and then you would have to, after you have finished the life of that construction loan, you will transfer the construction loan into a mortgage, and you can select a different company. The disadvantage is you might be appraised differently. A disadvantage is what if the rates have gone up? Disadvantage is who's willing to buy that loan, right? So there's all these various factors to consider before you do a two-time loan. That's why it is not as popular as a one-time closing loan. A lot of times they are helping you along the way with the one-time loan, because they know that will eventually become a home that you will live in, and it's the same company that's going to be mortgaging. But there's no drawback to two-time. If you like the flexibility, if you have a connection that can get you a good mortgage rate, and provided that you already have a home, a lot of times they do. So you look forward to those initiatives, right? Again, you got to worry about cost overruns when it comes to any construction loans. That's the only thing. When you're building your own house, you tend to get carried away with all of these, oh, I want granite counters, I want this bay window, I want this. So pretty much prioritize your needs over wants. You can have nice, simplistic, polished concrete floors, which will probably cost maybe $2 or $3 per square feet on top of the concrete, rather than this exotic wood that's being flown out from Africa. So you have to vary what you're trying to do, and it is quite possible, even in this day and age, to get a house that is custom built. Now, I will say this, that for a custom built home, including the price of the property, take into account that it's probably going to be $500,000, even in a state like Houston, or even in a state like Texas, upwards maybe about 20% on top of whatever you're going to pay for a pre-built home or a developer home, which is a KB home, Perry home, Lennar home, whatever it is, a new construction. You're going to probably end up paying 20% more than that, but it is practical for those who have the income for it. With that said, I tried to sum up as much as I could about the loans. Please like, subscribe, and comment below. And again, if you have any more questions, keep sending them and I'll respond to them as fast as I can. Follow for more content.